Governor, AFI's Deputy Executive Director, World Bank Program Leader, Deputy Governors, representatives of central banks, workshop participants, ladies and gentlemen, good morning and welcome to the third and final day of our Fintech Seychelles workshop. The first day was to set the stage for deliberations on the role of Fintech in Seychelles, as well as the opportunities, challenges, and risks that come with developing the Fintech ecosystem. The interactions gained momentum on the second day as we explored the regulatory requirements needed for Fintech supervision, as well as policies needed for data protection. The use of technological innovation to help monitor risks, such as money laundering and tourism financing, was also elaborated on. Today, we will conclude by exploring the way forward, including a focus on Fintech business models. We look forward to the richness of ideas that will arise from the discussions. Without further ado, let us start with the first panel discussion, which will be focusing on the theme Future of Payments. Dominant platforms or segmented players? Who wins? I would like to invite to the stage Mr. Matthew Sal, lead financial sector specialist from the World Bank Group, who will be moderating the first session.
Am I good to go? All right. So, as we've seen and heard quite a bit over the last couple of days, payments has been the leading edge of fintech innovation and adoption in many markets. Going back even in the I lost my ear. All right, thanks. In the U.S., PayPal is seen as one of the leaders in the current wave of fintech, even though really players like Visa, MasterCard, Fiserv, Mises, they were fintechs in their day, back in the day when we thought it all came from Finland. And the payments innovation continues to be at the core of the fintech revolution, particularly in this region and many other emerging markets, where we've seen the spread of payments-oriented financial technology as a leader that then facilitates the layering on of other value propositions and services. So looking forward into what's happening in payments, I think it's going to be important for us to try to understand the direction that this may take. This important sector is now rife with innovation, but also one in which there's some long traditions of players. The four-party model that was pioneered by the credit card companies, the newer business models pioneered by some of the telecom companies, the fintech models that are layering in on top of this, some providing their own infrastructure, some leveraging that existing infrastructure, the responses that banks are having. So there's a rich variety of things that are happening, and a bunch of great experts to talk about this with us this morning. We have Marcos, who you'll remember from yesterday, Pauline, who's joined us today from Airtel, Ruben from the Central Bank of Kenya to bring a regulator's perspective on how to address some of these changes and keep the systems safe, sound, and protecting of consumers, and Lu Ping from China UnionPay, and one of the newer but yet traditional style models, and hopefully we'll get a variety of perspectives here. And payments is something we all do, so there should be plenty of experience in the audience. This comes close to home, and everybody is encouraged to come up with your questions, comments, and participation as we go forward. So we'll go around across the panel to start with, just in terms of what's happening in the market that you see, Marcos, and in particular, how is the new sort of platform economics shaping the changes that we see in payments?
Yeah, thanks, Matthew. So payments has been, as a business, one of the oldest ones in financial services, and we have seen the emergence of large infrastructures to deal with day-to-day uses, right? So as you said, we have Visa and MasterCard and other kind of big international card payments networks. We also have Visa for wholesale. Now, they have a few characteristics. So because they are infrastructures, they're also networks. There are certain economic phenomena that we have seen emerging when we talk about payments on the basis of infrastructures. In the first, I guess, is what we call network externalities, right? So, and this also plays out in different business models, like platform business models, which I guess would be exploring as a new kind of business model that really fits some of the applications in finance, specifically around open banking, is something that we have been studying a lot. But I guess there is a strong network effect, which we actually had a paper out looking at SWIFT infrastructure and how the economics played out along this network. And we have seen that there is a lot of value to be gained from extra people joining the platform in itself. So we had a discussion with Ruben a few minutes ago before the panel, and he said that because a lot of people are already on M-Pesa, for example, which is one of the largest kind of payment systems right now for retail in Kenya, people are not tempted to go and move to other networks because they know that they have a lot of participation and they will be missing out. It's the same way, like if you're on Facebook or some other social network, you wouldn't necessarily shut your account down and move somewhere else because you'd lose all your contacts. So these networks externalities kind of really help to strengthen a particular kind of value proposition. Now, what that means for the rest of the networks, I think this is a competitive advantage that somebody who's a first mover actually has. So it might be interesting to discuss what is the lack of the kind of newer players in this sector, and how can they enter the industry, so to speak? What kind of value proposition they'll need to have in order to attract members from other payment networks that potentially have already, established themselves and have a bigger market share. So I can share a few more things later as we go on about platforms, but just because we talked about open banking briefly yesterday, I mentioned a few things. So open banking, we have seen, and because this talk is about business models, we have seen that a platform-based business model is something that a lot of people are keen to use or see that as a way forward in order to taking advantage of the new regulation. And network externalities is one thing that we are seeking. Now, specifically when we talk about platforms, the newer kind of idea around platforms in finance is how to bring outside innovation in rather than take advantage of the one-side kind of network externalities that we see. So that plays out like the iPhone, for example, right? So the iPhone is a phone, but it's also a value proposition, is also a platform because it brings external developers, external innovation, stuff that Apple has never been doing by itself, and matches it to people and consumers who actually use the iPhone. And we have seen that kind of similar example with Alipay or other kind of infrastructures in China, for example, where they have a value proposition, a core system, and then they allow their users to use external applications or external value propositions that are attached into this platform. And this is something that a lot of the companies in newer banks and newer kind of networks will want to explore on this fashion and kind of bring external innovation in. So this is just a couple of ideas on how some of the economics kind of play out in lay terms, I guess. There's a lot more to it, obviously, but I'm hoping we discuss that in due course.
Thanks. I'm grounded as an astronaut, but we'll keep going as a moderator. Paula, how has your business model developed and shifted as from a telco to a payments operator, and and what's next? What will be your core value proposition in the coming years? And if you want to comment also on how the network effects that Marcos described affect your business.
Thank you, Matthew. On behalf of Airtel Seychelles, we have, over the past 3 years, we have changed our model to include mobile money payments. In Seychelles, we were the first to launch this product, which provides a customer with the opportunity of making payments using their mobile phone. So 3 years ago, we approached the central bank and we agreed with them to launch this service in the Seychelles. We were the first to do so and are still the only mobile payments provider in the country. When we started to roll out this product in the country, we didn't have regulation yet because there was nobody else doing it. So we took some time with the central bank and ran a pilot study on a few selected customers in the country to see how the experience would be if we gave them the option to make payments using their mobile phone. It took us over a year to actually get the customer to understand how to use this product and how it will make their life more convenient. After the phase, the pilot phase, we got approval from the central bank to roll it out to the population. We have now been able to roll it out throughout the country. The penetration is still low because of several challenges. I would say one of the challenges we've had is we haven't had mass education to the population. We haven't done this big investment in this area, and also the country is quite highly banked. So we're having a good challenge to compete with the Visa card. But we have a big opportunity because the smartphones in the country have a very high penetration. We're over 150% penetration in the market. So we're looking at opportunities with a big spread of mobile phones in the country. We believe that we can easily reach out to the population. Over the past 3 years, we have quite some innovations in how we can make payment easier for the customer using their mobile phone. We have launched something called NFC, Near Field Communication, where we place a small tag on the customer's mobile phone and they can comfortably walk into a shopping mall. And after they've done their shopping, they'll just tap on a POS device that we have placed everywhere in STC, tap and put a PIN code and out they go. They don't have to wait to count cash and all that. We have also rolled out, at the end of this previous year, we rolled out a big number of automatic vending machines, kiosks, that are running on this mobile payments platform. What these kiosks are doing in terms of making payments easier is the customer will then walk with their cash to our kiosk, insert this cash into the machine, and the machine will automatically load their mobile money wallet, so that they can then go make payments, pay their bills, pay their TV and PUs and utility bills without necessarily using cash. So we are looking at spreading out these kiosks quite everywhere in the country. Right now we have reached about 20 locations in the country to try and bring convenience to the customer and make it as cashless as possible and make it easy for them to use their mobile phone for payments. So this is the area that we are trying to maximize as Airtel. And we hope that in the future, we will spread it further into the country and to the population.
Thank you. I think one of the aspects that you've drawn on is the competition that you have in this market, which is well banked from the direct use of bank accounts and related payments apps. So if somebody has a mobile app from their bank on their phone, what's the advantage then of using Airtel versus that mobile app?
Well, not all bank customers will have the banks have. I want to mention what limitations they do have, but I would say my advantage is that I've got every customer in Seychelles almost has a mobile phone. So we're together looking at how to make it convenient for them. We've actually reached out to some of the banks in the country to see how we can partner to integrate our system with their system. Because if I can make it easy for a customer in Seychelles to transfer money from their bank account to their mobile phone and then pay their bill or do their shopping, then we are partnering with the bank to make it more convenient. So I'm not really looking at the bank as a competitor right now. I'm actually looking at it at the bank as a partner to give the customer convenience.
Great. We'll come back later, perhaps, for Marcos to comment on whether interoperability reinforces or weakens those network effects. Ruben, I'm going to skip you for the moment, but not completely, to continue on sort of the payments provider side. Lu Ping, if you could come in now, representing one of the more traditional types of payments models. How is your business evolving, and how will you compete with these new players? And of course, you're coming from a market which has one of the highest penetration rates of the new types of payments players in Ant, Alipay, and WeChat. And how does a traditional card model position itself in the market with those kinds of platforms?
Thank you, Matthew. Can I, before I answer this question, can I ask a question to your audience? Is there anybody from WeChat and Alipay today? No, right? That is beautiful. But don't worry, I don't want to speak any bad words behind somebody's. Yeah. So first point of mine is that actually 2 years before, it's my first time have arrived Africa, and I know a very old wisdom of Africa. Actually, this question is perfectly answered by that old saying. So that is, if you want to go fast, you go alone. If you want to go far, you go together, right? So basically, we call ourselves four-party model as open loop. So that means everybody can join our network. Every bank can issue UnionPay card, of course, Visa and MasterCard. We call the WeChat Alipay closed loop because they control their own clients, and also they develop merchants by themselves, right? I don't believe that WeChat Pay can use in Alipay network. No, never, right? So we call that closed. So actually, closed loop is actually, you do everything by your own. So you can grow very fast. The advantage of closed loop is very obviously low transaction costs, guys. When they're doing business, they don't need to deal with anybody. They deal with themselves. They deal with their clients. They deal with the merchants. But they don't have to negotiate agreement with any bank. So the transaction cost is very low. So that's why they grow up very fast. But they also have disadvantage. The disadvantage is that the marginal cost is becoming high and high when they have more customers. So let me give you an example. Let's say WeChat, if they divide the first million customer, the clients, probably they're gonna spend $1 million US. One person, $1 US. But if they develop the second million customer, probably they're gonna spend $2 million US. And the third million probably $3 million US. The marginal cost will become higher and higher because they don't have synergy. They develop everything by themselves. For open loop payment systems, our disadvantage is that we have very high transaction cost. You know how many members we have? We have 2,000 members in the world. But every member, we have to spend a lot of time to talk with them, to negotiate with them the agreement. How many cards can you issue for me? And then the bank said, how many money you giving to me? Okay, and then we're gonna bargain, right? And we have competitors, they're gonna compare the price. So we're gonna spend half a year to talk about the agreement. So that's our disadvantage, very high transaction cost. But the advantage of open loop network is very low marginal cost because we have a big synergy. Because we have 2,000 members. After a bank issued UnionPay card, what's they going to do? They're going to find us, say, Mr. UnionPay, we have issued 1,000 card, UnionPay 1,000 card, but it's not the end. Can we do something to promote this card? Because this card is either UnionPay card and also the bank's card, right? We have to promote this card. It's not the end of our business. So let's do something together to promote the card. See, this is synergy. This is synergy. So by having this synergy that we have very low marginal cost so that we can go far. So that is actually my first point is that both these two business models have advantage and disadvantage. We can't say that 100 meters dash is better than 5,000 race. It's not right. We can't say that fast is better than far, but we do have both advantage and disadvantage. So you're going to choose which one is preferred to you. The second point is that I think no matter what kind of technology we are using today or what kind of technology we are developing in the future, I think business model is the key. Whenever you do payment, you always face a challenge. Actually, from my point of view, is that we are dealing with just one problem, is chicken and egg problem. Whenever what kind of open loop or closed loop, you always face this problem. I'll give you an example. If I quit from UnionPay, I establish my own brand, like say Looping Pay, and then I find, for example, a local bank, Nova Bank. I said that Nova Bank, I'm the company who have the most advantage, technology. I don't actually use mobile. Mobile is too outdated. I use I use Iris to pay. I don't use centralized system. I use blockchain. You know what is Nova Bank? The first question Nova Bank gonna ask me. They don't ask any question about technology. They ask me, Looping, how many merchants do you have? I said 0, sorry. But if we cooperate, then we can create more. But what they will recommend, I guess, is Looping, please spend more time to enjoy Seychelles. I think that's, yeah. So you're gonna face the first problem is chicken and egg problem. So let me tell you, WeChat and Alipay, initially, they're not doing payment at all. Alipay is the biggest marketplace, online marketplace in China. They have billions customers, and then based on that, they say, oh, I can actually build a payment network to enable my clients shop in my marketplace using my wallet. So that's the beginning. They're not targeting to do a payment company in the beginning. Alipay, so WeChat is the largest social media in China. And then they found that people sometimes will transfer money. If I say I got an offer from a very Warwick University, then my friends will send me money to celebrate. And WeChat said that if we can do this kind of wallet, then we can facilitate this kind of need. We can facilitate people transfer money between themselves. This is how they develop. They have a lot of chicken, and then they think, okay, we can do payment. So that is business model is the key. The second thing I want to say business model is that the easiest way to deal with business model challenge is actually to build a national switch for a country. UnionPay is the best example. UnionPay is established in 2002 as a national switch. At that time, before that time, every bank have their own POS terminal. So in one country, you're gonna have 8 or 10 POS terminals. Every bank have their own cards, right? You're gonna find 100 different cards in China. And then central bank said that only UnionPay. You guys need to connect with UnionPay. You guys only can issue UnionPay card. And then only 2 years, we issued billions of cards. We combined all the terminals in our network. We save a lot of synergy. We reduce the cost. We have done financial inclusion. Also, we have done digitalization, right? Because we are regulator of the specifications. So by having national switch, it's the most easiest way to conquer the chicken and egg problem. If you want to do that commercially, you're going to spend 10 years to deal with the chicken and egg problem. Yeah. Yes, that is actually some of my ideas about the business model. Thanks.
Thank you. We'll come back a little bit later, I hope, to talk about some of the technical differences between the different models, between sort of wallet type of systems and bank-led systems, and where some of the credit and operational risks may lie. But first, let's invite our regulator, Ruben, if you could tell us how, from a regulatory perspective, you look at this shift in the way that payments are done. What are some of the issues that you've grappled with?
Thank you. Good morning, everyone. Now, from Kenya, where I come from, financial sector and M-Pesa is almost synonymous. Way back in 2002, the payment system in Kenya was really too basic, rudimentary, if we can use that word, because 43% of payments then was through friends and family. For you especially if you're in the urban areas, you send money through your friend or your family. 20% was through public transport, another 18% postal services. In 2002, a microfinance bank, which was supported by an NGO to support the poor Kenyans in the rural areas, really asked themselves a question. We spend a lot of money to really send the money to the poor in the rural areas. At that point in time, the mobile telephone had just been rolled out, and the take-up was really impressive. One main item or aspect of mobile telephone which led to evolution of M-Pesa is where people were able to share airtime or credit for Safaricom, for that matter. If I have a friend who really doesn't have money to buy airtime, I can load my phone and share part of it for them to be able to communicate. Of course, some researchers ask themselves, can these also be used to send money as a form of money transfer? In 2006, therefore, the DFI of UK, the microfinance company, and Safaricom came together to come up with that platform of really transferring money to the beneficiaries of the microfinance. Thereafter, this really picked up, and it was transformed into a payment platform, person-to-person money transfer. Of course, the history is long, but currently, mobile money in Kenya controls 80% of the volume of the money, of the payments. However, of course, the large value payment system, the Kenya payment and settlement system, the RTGS, the real-time cross-settlement, still controls 90% of the value. So the mobile money payment platform is really a retail platform, for that matter. This mobile money was introduced when there was no payments law in Kenya. The payments law was enacted in 2011, whereas M-Pesa was introduced in 2007. So how did we ensure that, of course, there are no risks introduced into the system? One, the Central Bank of Kenya Act empowered the central bank to ensure that we have efficient and effective payment systems. And two, there is a trust law. So basically what was done is to ensure that this virtual money is supported by real money in a licensed commercial bank or a number of licensed banks used under the trust law. So that is how the initial controls which were put in place. At the same time, of course, the approach used to was test and learn. Initially, there were limits which were very low. The limits were set very low. For every transaction, you could not exceed $200. Of course, with time, this was expanded. Currently, the limit is $700 per transaction. So basically, those are some of the controls. So currently, the payment systems in Kenya, the mobile payment system is one of the most dominant. It is really, it has transformed to be a complex, and it's a dynamic. Every day, there are new reforms, there are new innovations taking place. But all these, of course, the regulators have partnered. The regulator for the mobile network operators, the Communications Authority, the regulators for the financial institutions, the Central Bank of Kenya, for that matter, they have an MOU so that, of course, all the value-add services, which includes the payment introduced by the mobile network operators, are subjected to the dual approval. And of course, the critical thing is to ensure that all potential risks are identified and mitigated. I think, Matthews, I want to stop at that for now.
Okay, well, we'll come back to you, I'm sure. One of the things we just heard was around limits in terms of the payments, and one of the areas that mobile money has struggled with is moving beyond that retail, in particular person-to-person payment, to penetrate merchant payments. One of the areas that that could potentially generate more information, more digitization of the, particularly for small businesses, and in turn, greater penetration of value chain transactions. At what point do you look to raise that limit and allow more value to go through the system? And perhaps Luping and Pauline can also comment on whether your particular digital payment systems are more well suited to retail or also could scale up to larger value.
Thank you. Initially, the mobile money in Kenya was P2P. However, with time, even merchants, even SMEs are currently using it as a platform of payments. One thing which should be very clear is that these innovations were introduced to serve a need, a customer need. What is very critical is to ensure that any innovation is market-driven, or there should be a need that it's trying to address. And the main need in Kenya was the unbanked population. When the M-Pesa was being introduced, only 15% of the Kenyans, adult population, were having bank accounts. As we talk now, the level of financial inclusion has moved from 26% in 2006 to 83% as at end of 2018. So, and mainly attributed to the partnerships between commercial banks and the mobile network operators. So basically, the issue of the limits is to ensure that, one, the payment mechanism serves the need in the market. And two, of course, we have to be very cautious about the likelihood of being misused for money laundering and financing of terrorism. Because, of course, the higher the amounts, of course, will create a fertile ground which can be exploited for abuse. So these limits are being increased progressively. However, it remains as a retail payments because the wholesale or the large value payments mechanism has also undergone reforms over time. Because, for example, in Kenya, the clearinghouse has been automated, for example. Check truncation has been there. Issues of value capping was introduced in 2009 that, of course, we prefer checks not more than 1 million Kenya shillings. And all the other amounts should be either through the large value platform, the CAPS or the real-time cross-settlement system. So as the mobile payment platforms are evolving, the other channels are also undergoing reforms to ensure that more channels are available to give choice to the consumers. So as currently, of course, the need or the customer need to expand or extend the limits which have been set are not on the table, but as and when that comes on the table, it will be considered in partnership. And of course, we must be satisfied as a regulator that there is need to extend. But currently, the level of satisfaction of that service is at a high level in Kenya. So that, of course, if you go to every corner of Kenya, if you ask somebody, which is your bank? Some people in the rural areas will tell you, this is my bank, the mobile phone. So I think that is where it is at the moment.
Thank you, Matthew. Currently, our system is very well suited to manage both P2P and B2B transactions. At the moment, we are still transacting with a few of our merchants, Intel Vision and PUC for utilities, for payment of these bills. But we are also planning to come up with bigger B2B engagements. And of course, we're working together with the central bank. We do have this engagement where if we need to have a limit increased, we go to the central bank and present our argument. For instance, we kicked off with a transaction limit of about $140 at the start. But then we realized that there were many Seychelles who had bills to pay beyond this limit and also transact beyond this limit. And we presented a case to the central bank, and this limit has recently been just increased. The system is very well configured to provide bulk payment and transactions. Right now, at the moment, our Airtel employees wish to have a percentage of their salaries paid through mobile money. And for about more than 2 years now, about 4 to 5% of the salary of all our employees is paid through mobile money. And they look forward to that day when they get paid and rush out to make payments using their mobile phone. We believe that in the future we'll extend this service to the government agencies that want to pay social security payments to people, to make it easier for them to be paid through the mobile phone. So the system is ready. It's just us that are still limited with our options to maximize the system.
And China Union Pay, large value payments, given the interchange structure?
For us, it's easy to deal with the limit problem because we are open loop payment network. So we give the right to our partners to decide the limit they want to have. From the market is different from one to another. For example, in America, the limit should be a little bit higher, probably, than the limit in probably South Africa. So we give the rights to our partners. We just from a very high level to control the fraud rate and also to control the risk. But most of the time, we give the right to our partners. Yeah, simple.
Marcos, coming back to you on the question of interoperability and how does that affect the network effects. And if you might also comment, I don't know if there's an area, but when we talk about the network effects and the early adoption stages, the cash in, cash out role, and is that going to be something that sticks with us? And then we'll talk to Airtel about that as well.
Well, I think, first of all, one comment on what the gentleman from UnionPay said. One of the things that we have seen basically in payments is that a lot of the retailers or a lot of other industries, a lot of people seek to absorb the payment function within applications or the user experience that their customers have in their own hands, right? So one example was Alipay. I guess another one is Amazon, right? So the first thing that Amazon sought to do was to bring in the payment to their own platform. They didn't want external kind of providers to be doing that for them because they thought that was a very important thing about their customer experience. So these, and now they're expanding actually. I don't know how many of you have seen that Amazon Pay basically is, or Payments Amazon is trying to integrate as an infrastructure platform, let's say, or a solution to other instantiations outside Amazon in itself. So they have a partnership with WorldPay right now where wherever you have a WorldPay terminal or WorldPay kind of function on a website, you can actually choose Amazon Payment as one of your options, like you would do with Visa, etc. So we've seen the emergence of payment offerings across many different industries and many different kind of bigger players, and what they seek to do is basically interact and integrate themselves to other value propositions, across many different products and services. And this is, when we have more openness into the system, we talked about data yesterday and data standards. When you have this ability to integrate and basically interact with other systems, what we see is that a lot of layers are being built on top of other layers. So we have a more kind of like layered architectures that allow people to have more choice and kind of interact with different systems and services. So this is, in terms of the standards, I think is really important that one would consider opening up. I guess the offering from UnionPay to use other terminals wouldn't have been there if an open data standard wouldn't have been established and allowed them to tap onto the existing kind of infrastructure, existing terminals, right? And this is something very strategic. So it's a company's choice or a payment system's choice on how much they're willing to go in terms of opening up the standards to be able to interact with other ecosystems or other layers in the stack of the technology or the stack of the services and value added. That has pros and cons. Obviously, if you're a very closed system, you might be able to rip off or to reap a lot of the benefits, not rip off the customers, to reap a lot of the gains and the benefits yourself without kind of value sharing with other kind of networks. I mean, Apple has been doing that. They're talking about mobile companies, I guess. Apple is a phone manufacturer, but they're more closed, so they have their own operating system. They wouldn't necessarily allow the system to be used in other phones, etc. So Google has another kind of approach to it. Their kind of phone agnostic. They can be used in different phones, etc. So, and they're more open in terms of what kind of applications they can have on top of their operating system, right? But they have less of the benefit of being kind of more exclusive or integrated in one phone and selling that phone. So Apple is saying that if you want to use our operating system, you can only use it if you buy our phone, right? So they're creating more market for them. But being more open kind of gives you more possibility to open up other revenues, like Google says and does revenue sharing with other phone manufacturing companies, and they get more revenues from that. So that's kind of like a strategic choice, how much you want to open your platform to interact with other systems and embed and connect with other infrastructures as part of the kind of value that you offer your customer. I guess in your case, it would be ideal to work with the bank, but maybe the bank will think, well, I'm going to have a lot of my profit going through another company now, and a lot of the interaction with the customer going through another layer because of this openness. So that's kind of like a strategic decision for the bank to realize whether they would actually go on and do collaboration with you and what kind of the benefits they can offer to the customers. Now, a lot of collaboration, what we've seen also in platforms, is that sometimes kind of inverts the firm. So that gives the ability, because you used the marketing idea before, that gives the ability, for example, you to market the bank that you will collaborate with as part of your value proposition because you're now interconnected with them. Right? In the same way, for example, an application would be increasing the value of iPhone because Angry Birds, for example, is a standard case study when we talk about these kind of business models. They were promoting their own product, but because they had in the beginning of their kind of operation, they had an exclusive deal with iPhone. Essentially, they were marketing iPhone, right? They were saying, "Come and play Angry Birds, but you can only play it on an iPhone." So it kind of inverts the firm in that it creates more of the marketing, the sales, and all these functions that traditionally a firm has within. It kind of takes them outside and blows them up. It's across many different kind of applications and value that sits on top of the platform. So there are certain benefits, pros and cons for all the different layers in the architecture that from openness. But this is kind of a very much strategic decision. There's no one single way to go. I think it's what kind of the customer wants in the end of the day, as has also kind of been mentioned, and how much you can take out from these synergies that you might have in the end. And my last example would be Swift. Swift has been a payment system that traditionally has been very closed. Right? Now they're thinking about opening up and creating their own APIs to get external value proposition. But this is something that they've been thinking about 40 years or 50 years even, and now they're coming around because they see the platform as a business model where openness as a strategy is more catchy, kind of something that is catching on in the payments environment more and more. So I guess some thoughts to connect with the previous comments and perhaps think about and what the strategy could be in each of these cases. Right?
Well, one of the aspects of these network interconnectivities and the adoption cycle is this continued need for cash. Pauline, can you tell us how that's working in this market? Are there a set of cash in, cash out agents that work alongside this, or given that most people have bank accounts, is it all switching in between the bank accounts? And how persistent is that need going to be? And then perhaps we can hear a little bit about the Kenyan experience in that regard.
Yes, our proposition to the customer is to make it easy for him to actually convert the money on his mobile into cash when he wants to. In a remote area of this country, there may not be an ATM close by, but if he can easily walk to a nearby retailer shop and convert the money on his mobile into cash, then that's much more convenient for the customer. So our idea is to spread the agent coverage in the country to every retail shop out there in the country to make it very convenient for you. For the customer in Seychelles, as well as also cashing in whenever they feel like converting their money into a mobile wallet, then that will be much easier to the customer if we take it down to the retailer in the country. Like I mentioned earlier, right now this is possible on all our automatic vending machines in the country. So we've tried to bring it as close as possible to the customer. It's still not, I'll be honest, it's not yet highly spread out. We still have room for growth. We still have work to do, but the country provides a good environment for this business to grow.
Ruben, can you tell us a little bit about some of the interoperability issues at the agent level, and also whether you're seeing a persistence of cash in, cash out, or as merchant acceptance and other use increases, are people keeping the balances inside M-Pesa?
Thank you. Initially, M-Pesa was mainly for immediate transfer and access of the cash. Of course, in late 90s, early 2000, Kenya experienced a crisis in the banking sector where quite a number of institutions collapsed. So initially there was need to build trust in this delivery channel. With time, of course, people started, when they receive money, they don't cash out all the amount. The phone became, their account where they can keep part of the money. So, but that was initially what was meant to achieve is to take, of course, closer to the common man, or as we call the common man, as much as possible. So over time, the mobile network operators have recruited agents. As of 2007, we had 1,500 agents. Currently, we are talking of 223,000 agents spread across the country, telling you that this has really taken financial services closer to the people. The Central Bank of Kenya did not really just wait to see mobile money agents taking it to close to the people, because the mobile network operators are under the primary regulator, Communications Authority. So we introduced agents for commercial banks. We introduced bank agents who will also offer those services which the mobile network operator agents are not able to offer, including mobilization of deposits and of course the payment for loans and cash withdrawals. So the two platforms really have worked very well. The only difference is that for the bank agents, there is no exclusivity. One agent can serve as many commercial banks as possible. It is clear in the law that there is no exclusivity. However, for the mobile, of course, their laws allow for exclusivity. You will find that for M-Pesa, their agents are for M-Pesa. For Airtel Money, they are for Airtel Money. For T-Cash, which is Telcom Kenya, they are for Telcom. So, but there are discussions to see whether it is possible to really require that there should be no exclusivity, so that we take these services as closer to the people as possible. So, despite those agent networks really increasing exponentially, discussions have been held, and in 2018, the 3 mobile network operators entered or rolled out an interoperability mechanism through a switch. But it has not really picked up, but currently discussions are going on to ensure that it works. One main challenge was on the fast mover advantage of one of the mobile network operators, which of course always they want to safeguard their market. But interoperability will really help. As we talk now, you can even buy airtime for Safaricom from Airtel, unlike before. So interoperability is something which is being discussed, even among the banks. There was a rollout in 2017 of a switch to allow banks who sign in for you to transfer money from one of the member banks to another one. So interoperability is an area which is really being explored to ensure that there is a seamless flow of financial transactions.
Thank you. I want to leave a little bit of time for questions, but just one last important one for the panel to weigh in on, and this is about the risks, and there's operational risk, there's credit risk that's implicit in some of these models, but not others. So how are the risks to stability, to integrity, credit risks, how do those shift when we move from cash to bank to wallet type of models? You can speak particularly to the ones to the types of systems that you operate, Luping and Pauline. Ruben, from a regulatory perspective, how do you look at how these risks are managed? Perhaps anything that you've seen from Marcos, from the SWIFT and other networks. And so let's help our audience to understand that these different business models have different implications for credit risk, for operational risk, for consumer risk profiles.
A brief idea from mine is that actually by using technologies, we actually mitigate risk from time to time. For example, in the cash world, actually the risk is very high. You have to take a lot of cash. So by using bank card, you already reduce a large portion of the risk.
Security risk.
Yeah, the physical security risk. But of course, you bring some new challenges, right? People are gonna copy your card, but compared with the security risk that the cash would have, that is become less. And by having EMV technology, that we also reduce the counterfeit card risk. Yeah, even though that for EMV that increase some cost and also bring some new type of new risk, but actually compared with magnetic stripe, it is actually much better.
Just for everybody here, EMV is the chip in the card?
Yeah, chip in the card. Yes, it's chip in the card. And also now we have more channels so pay for payments. For example, QR code. For example, contactless. Initially, that we found in China that people don't believe these things. People think that I'm not familiar with these new technologies. It's not secure. It's not safe. But what I say is that very quickly they actually change their mind. Only a few years people are getting used to this simple, better cardholder experience ways to pay. And also our risk management system can betterly actually control the risk of these new technologies. For example, in QR code, we can put chip data in the QR code. It's also copyable, for the QR code. It looks very simple, but we can also do some algorithm or some ways to ensure that the security things. So as technology developed, I think the total risk of payment is actually reducing largely. Yeah, the risk that people say is just the fear that when they face a new thing, but actually they will know that it's not always a problem by technology. That is my view.
Thank you. Now, there are basically three major risks which is of concern to the Central Bank of Kenya. The first risk is cyber risk, which is really with technology, it is becoming so prevalent. How we are trying to contain is we've issued guidelines to the commercial banks and the payment service providers on how they must ensure that their cyber hygiene is very high, that cyber risk is taken from the top. So guidelines were issued to the commercial banks in 2017, and currently we are at the final stage of issuing cyber security risks guidelines to the payment service providers, including the mobile payment service platforms. Secondly is credit risk. Of course, the Kenyan population, more than 50% are the youth, 18 years to 35 years. And these are the people really, when these innovations come, they are quick to adopt. And over-indebtedness is it's looming. It's likely to be a problem coming up. We have even started seeing the level of non-performing loans going up especially the lending through the mobile platforms. And therefore, there is an effort to try and roll out, of course, financial literacy to ensure that, of course, the Kenyan population is financially disciplined. It is something which really the regulators are partnering with the Ministry of Education so that it's even included in the curriculum to ensure that these people are trained or we build financial literacy from an early stage. The third risk, which is of concern, is the availability of the service. 2, 3 currently they are looking at ensuring that they have more than 2 networks, so that if one is down, at least they are fallback. But that one is a critical risk in the sense that it might erode all the confidence the public have gained over time over these mobile networks, these mobile money products. So those are the 3 which I can mention that the regulator is currently concerned. Of course, others have been discussed during this workshop, including the data protection and consumer protection. And all these are really issues which are discussed before any approval of new innovations are approved.
Thank you. That's an important point. As telcos move from communications networks to critical payments infrastructure, there's a different approach that needs to be taken from the regulatory perspective.
At the moment, the Airtel Money platform in Seychelles is built to accommodate more than 200,000 people, and that's more than twice the population of the country. So I would say we are largely underutilizing the system. So in terms of the risk of system crash, it's not good. I can sleep comfortably at night that I have no exposure in this area. But we are looking at future risk that we'll be exposed to in terms of credit risk. Currently, we are offering credit on our mobile communication side. A customer can be stuck somewhere in Seychelles and has no airtime and wants to borrow airtime from us. We are providing that to the customer. They dial a code and we can lend them airtime. When they come back to town, they can buy airtime and I will deduct that from what they've purchased.
So in that sense, you're following the payments company Stripe, which originally was to accept payments and then began to issue credit to the merchants and payers. And appropriate that we're talking about Stripe, given how you're dressed today.
Thank you. So I would like to extend the same service to my Airtel Money customer in the future. This, again, is not done yet. We are still planning on how to manage that risk based on our current portfolio of customers that are borrowing on the mobile side. And when we get there, I think it will be manageable. We'll get in touch with the central bank and get guidance on that.
Yeah, so I think, traditionally, if you look at different examples of case studies, I think payment infrastructures have been quite resilient and quite secure. I think most of the risk doesn't come from hacking Visa in itself or hacking SWIFT in itself, but basically hacking the end customer or the node that actually has access onto that kind of payments network. And this is something very important because it goes back to education or making the customer authentication process more secure. This is something that they've really taken a bit more seriously in the open banking kind of narrative, where they're trying to do kind of a two-factor authentication, for example, to make sure that customers themselves feel more secure, because they would need something that they own and something that they have and something that they know and they remember, rather than just using a card. Because I mean, card fraud is quite big. Like I was trying to find kind of a number on the top of my head. I don't exactly remember, but a lot of the banks and financial institutions that issue cards, they write off billions of dollars of fraud per year. But that's okay with them because they are, they can take this on and the profits are much bigger. But I guess moving now to new payment systems, I think having a secure customer authentication at the point of the customer, it's probably going to be way more important than the resilience or the cyber risks that the payment platforms themselves kind of have as information systems. And this is something that we have seen again and again. Like most of these incidents you see out there, like Bank of Malaysia, since we mentioned it yesterday as well, has been because of the weakness of the central bank to secure their systems. I mean, even the blockchain environment, nobody has hacked the Bitcoin blockchain. It has always been people who were hacked at the point where they keep their private key on their wallet. So, yeah, I think more education needed and more security at the customer, at the end point where the transaction, the payment is being initiated. I think that's the most important lesson.
So it's been the Bitcoin exchanges that have been hacked, or in the case of, in the US, it was the Target department store whose database was hacked, not the actual Visa, but the Visa card information that was being stored at the retailer. Right. I want to come back, or ask the panel to come back on something that Marcos introduced before about contextualization of payments. Nobody really ever wants to make payments. We're really happy when they disappear. So when I take my ride-hailing app and I go and take a ride, I want to get from place to place. It's not that I don't get in that car because I want to pay the driver. And so if the payment disappears, I'm perfectly happy. When contextualization of payments continues, and that changes the way that payments are delivered, how does that change the way your business model will shift? How does that change the way you will regulate it? We'll come back to that at the end. Meanwhile, let's go to the audience and see if we've got any questions, comments, observations. Everybody does payments. Everybody knows this. Got to have some questions, comments. I think we've got.
Thank you. I'm from Zimbabwe. I've got, I need to hear from colleagues here, if they can share. Is there any country where these mobile money operators or these network operators share the physical infrastructure? Because you get some areas where one company is very dominant with its network infrastructure, the other one does not exist. And there, that's where the citizen says, I wish I could ride on another network. Just to share with the colleagues, is there any such? Because you find dominance by one player, but we want the service as a country. Thank you.
I'll answer your question because I want to share the example in China. That actually, you know, WeChat, Alipay, they're very big, right? But actually, they are using UnionPay network. You just give you an example. About if, for example, in my Alipay, I actually bound about 4 UnionPay cards into my Alipay. And then by this, by having this card, I can transfer money to the wallet, right? And when I use Alipay to pay, I don't need necessarily to use the wallet, to use the money in the wallet. I can also use the money in my card. Then Alipay become PayPal. So you see that Alipay and WeChat are using our network, but in the same time, we are also using their customers. We're getting the customer in our network. So by having that point, I want to deeply elaborate a viewpoint of me is that actually the cooperation between closed loop and open loop will be more and more deeper in future. Because what open loop player want from closed loop is their customers. They have a lot of customers. They grow very fast. But what the closed loop players want from us is our network, right? Visa card have acceptance in 200 countries. If let's say if M-Pesa can use their network, that is wonderful, right? So there must be some cooperation between a closed loop and open loop. That probably can answer your question. Yeah.
Anybody else have thoughts on the shared infrastructure?
I'm agreeing with UnionPay because it works in their model, but across telecoms, it's virtually impossible for us to share when it works.
Okay. Other questions, comments? How many people here have, in the audience here, have used a mobile app to make a payment? Okay. Of that, how much was a mobile money from a telco versus mobile from your bank? So is it telco mobile payments, bank type mobile payments? Okay, so a bit more of the. We're all a pretty well banked audience then. Not so surprising. How many of you have done a payment that's been sort of embedded in another activity? That you didn't really go to do the payment, ride hailing, for example, or using the mobile app within e-commerce or another type of payment. So a little bit less contextualization happening just yet. As we look towards that future, how does that contextualization change the way your business model will deliver payments? And for Ruben, how will you think about regulating when the payments are being done by Uber or Grab or Careem or being embedded completely in a solar network or
Okay.
other type of delivery?
Actually, it's the first time for this conference. So I want to answer this question in another way. I want to have 3 forecasts in the next 10 years. Let's say that if I got the chance to come back, let's say that whether it's accurate or not. Okay, personally, I have 3 forecasts. The first one is that in the next 10 years, I believe there will be at least thousands or 1,000 this kind of closed loop or wallet will appear in the world. In Africa, I believe there will be hundreds of these kind of closed loop wallets appears in the world. But there will be only 5 to 6 open loop card scheme, like the Visa MasterCard, in the world. As always, there's I don't believe there's more this kind of open loop will appear in the market. But unfortunately, most of the closed loop within this 1,000 will disappear within these 10 years. Let's say, because they are fast, but they're not far. Yeah. The second thing is that I think around the world, there will be more and more countries will build national system, national network. Probably there's only 50 around the world, based on my statistics. I believe that this number will be triple within the next 10 years. The third forecast is that there must be more and more cooperation between open loop and closed loop. Even some telecom companies will share their network. Let's say that is my word in 10 years. So that is my forecast. Probably can describe roughly the future in my hand. Thank
you. Of course, from a regulator's perspective, is that the critical thing is to build skills to understand these new models. For us, really, to be able to prescribe the enabling regulatory framework. Safaricom, for example, has tried to come up with an e-commerce called M-Masoko, Mobile Masoko, meaning a marketplace. It has not worked very well, like for other platforms, but compared to the mobile money, the money transfer and payment platform. So as a regulator, the critical thing is to build the skill base to ensure that we understand the models and be able to identify all the risks. And of course, partnership with the counterpart regulators, like the regulator for communications, is very critical to ensure that, of course, these new developments will not create instability or will not cause instability in the financial sector. So I think that is the message which is critical. Of course, we may not really point with certainty how it will evolve, but I think the future, there are new things which are coming.
On the telco side, I believe that the future, one of the things that we'll need to do as part of our strategy is to partner with the bank to integrate my system with the bank system in order to make this my payment platform as an option when the customer is transacting within an app or within a link. I do have more than 65,000 customers on my mobile network that I'm sure a bank would want to strategize with us on to see how to maximize those customers to become part of their portfolio. So part of our strategy would be to see which bank would be ready for us to, integrate with them and get this facility provided to the customer.
I guess I agree. There is, I think, quite a big move in terms of bringing payments closer to the experience of the customer and in the end kind of making it invisible in a sense. We're talking about invisible payments these days. I guess Amazon, again, in my head is a very good example where you're actually buying something for Amazon, and by all means there are more kind of online markets out there, but when you buy something, you just click that you order this, and that's it. So it's the one-click pattern that Amazon has. And they're trying to lay this out to different networks and integrate, like with Amazon payments being also embedded in as part of the WorldPay kind of universe, you can actually use your Amazon payments kind of across many different retailers online, right? So they're trying to embed that experience, that very smooth, almost invisible payment experience, integrated across other marketplaces. But it's not only Amazon. There's quite a few companies, like even Starbucks. They have their own payments now. They're all integrated into the app, and you can kind of smoothly kind of make the purchases. I think one thing is convenience and customer experience, which is, I don't know if you remember yesterday's presentation. I think Kai kind of mentioned that in his presentation a little bit. I guess the other is the race to gather more and more data. Because data is still king. Data is kind of the way forward for a lot of these business models. Even if you look at platform-based business models, even open banking kind of implementations, everything sits on the value of data, right? The more data you have, the better you can understand your customer, the better you can monetize this, etc. So I think a lot of it is about data. I mean, if you think about Apple Card, which is kind of like a new value proposition, I don't know how many of you have seen that in the news, again, is to bring, not necessarily to profit from the payment itself, but to create a smoother customer experience and make sure that you now are able to collect more data about your customer. Before, Apple had a lot of data for you if you use their wallet, but now if you adopt a card, you're actually using their wallet, but also using a card that allows you to, to pay across. And thus they'll be able to know a lot more about you, in terms of what you purchase and how, etc. So
and appropriately, Stripe's lending to merchants is built on its knowledge of the merchant's income through the Stripe.
Yeah.
So you're representing your shirt as well.
Yeah, exactly. I do, yes, of course.
So
yeah, that's, I guess for me, it's data, customer experience, and we'll see that a lot more, that kind of bringing the payment very close to the customer experience in the transaction in a particular context. I think that's going to happen more. Now, what are the implications for all of you guys? I'm not sure. I guess at some point you need to accept that a lot of these propositions will be utilities. I mean, Visa and MasterCard have been branding themselves for quite a few years. I think they had an amazing run if you think about the expenses and the cost that they're actually charging people. I think that's going to start disappearing. And I think with open banking and openness in the environment, more and more open data kind of going around, they might end up kind of being more utilities and losing that kind of front customer experience that they claim so far. So I mean, there's a lot of things are going to change. So,
okay, thanks. So if I can summarize a little bit, we're going to see payments embedded into other activities, more and more usage across the different networks, gathering more data and leveraging that to create new value propositions. We have lots of wallets that may come and go, but the closed loops and the open loops may have greater integration into loops. And finally, the message we had from Ruben, the importance for regulators to build their skills to understand these new business models and identify the risks and be able to supervise and monitor those effectively. Can you join me, please, in thanking our panel?
Our next panel discussion will be elaborating on a topic that has attracted significant attention globally, that is crypto assets. The session themed crypto and decentralized systems shall not only explore crypto assets and the distributed ledger technology that underpins them, but also the potential benefits and challenges, as well as the regulatory frameworks needed to accommodate them. The World Bank Group's lead financial sector specialist, Mr. Emil, will be moderating the session for this theme. Mr. Emil, the stage is yours.
Good morning and welcome. It's very impressive to see so many people still here on the third day. Usually with these types of events, come the third day, come the morning of the third day, people slowly but surely start finding other things to do, and particularly if you have the beach there and lovely nature up there, it's impressive. It's a sign of dedication. Maybe it has something to do with the fact that the governor is still here to enforce some discipline on you all, but very encouraging to see that. Yesterday somebody commented during one of the panels how impressed and pleasantly surprised he was that this whole conference hadn't been an endless repetition of the words blockchain and DLT, because for a long time, a lot of these fintech events, it was incessant. It was all about blockchain and BLT and BLT, bacon, lettuce, tomato, and it seemed that hype would never end. But maybe, as Nick said on the first day, maybe we're getting past the hype and actually seriously looking at what does it mean and how can we use it? How can it really solve a problem, rather than thinking that every problem is a nail that requires the hammer of DLT. We're now looking at where is an actual problem that could be logically solved with these types of instruments. So that will be the, we will really be talking about the technologies in this session and their practical applications in some cases. Before I go on, I should note that it has Alan there still on the slide. In fact, Alan wasn't available, and we're very glad that Nicolas Setoup was able to step in at the last moment on behalf of the CBS. So I'd like to start with you, Hervé, to kick us off on a bit of a demystification of what it really means. What is Bitcoin all about? What is DLT all about? How does it work? And how important is it that we all understand it? Is this just something we can leave to the IT sector, or should we all be aware of what's going on there? So, Hervé, you have the floor. Thank you.
So, can you hear me? 1, 2, yep, you're good. So I was asking in 5 minutes or less to educate you everything about crypto, everything about DLT. I will not do that. But I will show you, I would just put on the table the things that represent that world. Don't expect me to explain to you in 5 minutes exactly how that works, but I want to give you a sense of what's behind it, right? So it's purely an introduction, if you will. So does it work? Trying to click in the air. There you go. Somebody clicking for me. First of all, like coming from the IMF, so what is the relationship between the IMF and crypto? Not much, as a matter of fact. We do recognize its existence. We do recognize its disruptive effect. And by crypto here, I will use the word that I will try not to use later, cryptocurrency. FYI, you have noticed that most central banks and the IMF and the World Bank do not use the word cryptocurrency because we do not recognize that it has the currency characteristics. So we say crypto assets in general. And in this presentation, I'm using the more specific word payment crypto asset when others would use the word cryptocurrency. But in any event, the relation between maybe the IMF and crypto is best explained through this quote from the managing director. I'm going to read. Cryptocurrencies, she did say cryptocurrency in that case, seek to anchor trust in technology. That's the nature, that's the promise of the technology itself. So long as they are transparent, and if you are tech savvy, it's true, you have to understand that it works. You might trust their services. Still, I am not entirely convinced proper regulation of these entities will remain a pillar of trust. So that's pretty much the summary of how the IMF approaches crypto. Recognizes they exist, recognizes they may have some value, but remaining vigilant through regulation. So without touching crypto, payment crypto assets, we have three approaches really around that. There are three things to keep in mind. First of all, the Bali Fintech agenda. Sharmista yesterday presented with a different form those elements. So they're quite useful. They're quite useful. In fact, I underline in green here. You won't be able to read the details, but we'll share the slides. That many of those Bali FinTech agenda elements do cover the question of crypto in general, in one way or the other. In the context of this particular presentation, it's the Bali FinTech agenda number 5. Which called to monitor the development of those technologies. So a point here, bit to your question, Emil. Yes, it is important that regulator, policymakers, economists do understand at a certain level those technologies, and that's what I'm introducing here. You may have seen the work that the IMF is doing on CBDC, central bank digital currencies. Notice we do not believe necessarily that DLT or crypto, DLT or blockchains are the only way to do to implement CBDCs. But CBDCs as a digital money concept is something that interests us very much, and we're studying that, including through this pretty popular paper that was published in November, I believe. And the third angle is most of my work, which is taking a step back from crypto itself and understand that crypto themselves do not work in isolation of the rest of the technologies. So it's very important to understand you cannot understand or you cannot grasp any of those technology in isolation of what we're calling the 14 technologies that matters to central banks and member countries. We're calling those a member tech, if you will. From the top down, we talked a little bit, even in the previous session, about the concept of user adoptions. You cannot roll out any fintech solution without thinking of how this is going to be adopted. So the concept of user experience, digital literacy, financial literacy has to be exploited, even in the context of crypto. I will not go into the details of all of them, but I want to make the point that the devices are going to be used, how the data, whether it's crypto or not, is going to be acquired, the privacy consideration, the user protection aspect of it, the storage. You see all that the way to the bottom, you've got the concept of cloud, where the data is stored. And we'll talk a little bit later about really understanding this conversation about storing the data on the cloud. We've seen in previous sessions, we understood that there was fear associated to storing data in some places, inside the country, outside the country, in the cloud or not. It's important to understand at a certain level what's the reality to a technology point of view. So we'll talk a little bit better about that. So the digital platforms, that was the previous session. This is spot on. It is at the center of those discussions, included for crypto. API, the way you share this data, the word open data was used in the previous session. This is how you share the data. A fintech strategy cannot ignore any of those elements. So crypto, though it is important, we recognize at least 3 of those 14 technology are about, if you want to call that crypto, the concept of tokenization, the concept of digital ledger technology, DLT, also known as blockchain. Smart contracts, I think it's important to isolate this particular technology and understand exactly what's the potential and the risks of smart contracts in themselves. So this is what we do in my team, if you will, trying to better understand the benefit, the risks, and the trends. The trends allows us to understand the hype, which is also an important thing that I'll touch upon later. Anyway, this is how we're studying crypto in the context of this particular presentation. Oh, I missed an important point here. If you want to left click for me, yeah, I go. You see the word learning coin? I don't know how many of you have heard about this project of the IMF and the World Bank, learning coin, by show of hand. Of you. So that's actually a project that we did at the IMF and the World Bank where we did develop our own crypto asset. It's not a payment, it's not a cryptocurrency, you would call that at all. It has no monetary value, but it is using the exact same technologies that cryptocurrencies or Bitcoins or Ethereum would use, because we did want to have our hands dirty and actually touch those technologies. So we did develop the whole stack, those 14 technology, if you will, around the crypto asset, so to have a deep understanding about how that works. That has been extremely popular and very useful for us. It has fast-tracked our understanding in just a few months. By touching those technology and developing that in-house, we were able to really deeply understanding what we're talking about here and be in a much better position to understand where the hype is, what's real, what's not real, to a technology point of view, but also we had economists, we had statisticians, we had lawyers in the team, and all of them gained a lot by doing something like that. So it's a project I'm happy to talk more about, maybe offline. All right, so that's the part I was asked to introduce to you, the definition. What are the words, what is behind crypto? So I won't lie to you, it's complicated. And do not try to understand all of those things. I mean, for a while, that was my specialty, understanding the blockchain. And I've got to tell you, just crypto itself was a full-time job. Every single day, many times a day, you've got news that are changing that world, if you will. So you don't want to spend too much time about that, but you want to understand that it is complex and that has consequences that I will talk about. So anyway, that's really the more basic definition I can give, that most of you are already familiar with distributed ledger, in the sense that as opposed to the way illustrating here with the central banks, where it's central ledger. And a distributed ledger, you've seen this picture many times, is where there is no central authority to coordinate how the data is being validated and processed. So it's a very different model to look into how data is being owned, processed, and created. So that becomes a bit complicated, right? Because DLTs or blockchains can be public and permissionless, meaning nobody has different authority over anybody else. In fact, something like Bitcoin cannot even be shut down. Nobody in the world has the possibility, even the creators of Bitcoin cannot shut it down, unless they politely ask every single node of people running that software, they ask politely to shut it down, and then the Bitcoin will stop existing, but that's not even possible to do that. So that's a concept of public and permissionless blockchains. Then you've got a public and permission blockless blockchains, where it's still available to everybody to access and to acquire coins over that particular network, but the nodes are controlled. Somebody like Ripple, for example, will decide, okay, this bank or this entity can run one of those nodes to process the payment, for example, or to validate the coins, and nobody else. So there's a bit more control at that level. Much more control is the private and permissioned blockchain. I should say something about the public permissioned, going back up. A central bank digital currency using DLT for its implementation. They don't have to, but if they do use DLT, they would probably go for the public permission, meaning available to the public, but still retaining the control over what's going on there. Now the private and permission, this is more your enterprise blockchain, which is not available, like the learning coin is an example, is private, only available to the IMF and World Bank. Permission, we decide who can run the nodes within organizations. Some argue this is you've got the extremists in the world of blockchain that would tell you this is useless. Why don't you use a regular database to do that? They may be right. I'm not arguing with that, but there is such a thing as a private permissioned blockchain. So of course that gives you some headaches already. You've got so many dimensions already here. There are some unique characteristics that we need to acknowledge. You know, it's not a database. If it was a database, you would use a database. Little note here, I do believe that 8 out of 10 projects you see out there using blockchain should use a database. But there are some unique characteristics that make it absolutely valid. The definition of a particularity of blockchains, or DLT, is that the creation of new digital assets that did not exist in any other form before. So of course, Bitcoin is an example, and Bitcoin remains within that particular system, if you will. So that there's something unique about being able to create something out of nothing, in a way, a digital asset. Tokenization of existing assets, that's also interesting to understand that there are some existing assets that existed before blockchain that you can tokenize, hence the term tokenizations. An example is rights, land rights, for example, or if you've got a house and you want to put the title on a blockchain, that's also the way people are using blockchain. So it's a tokenization of existing assets. More particular to blockchain, quite unique to blockchain, is the ability to transfer those tokens using mathematics, in a way. So you create what the managing director was talking about, this trust through cryptography, instead of having a central bookkeeping. So that is something that is pretty unique to, and the projects that really understand that correctly are usually the ones that we think are valid projects for using blockchains. So there are good things, but before we look into the drawbacks and the risk, if you will, a little bit of definitions. Heads up, many institutions have their own definition. So I picked one, but feel free to disagree. I mean, there are many ways to describe crypto assets. There is what I called before the payment crypto assets. Some people call that the cryptocurrencies. Some of us may be talking later about stablecoin and digital coin. You've seen that JP Morgan has issued their own coin, bank coin, called that digital coins. Stable coins, by show of hand, who has heard the term stable coin? Not even half. You know that Bitcoin and other cryptocurrency are very unstable. You know, they move from a few cents at the creation to $19,000, and then back to $3,000 in just a few months. So that's not something you can use as a currency. So people came up with something called stable coins, which is collateralized with all sort of assets behind to try to keep it stable. This is a model that a central bank digital currency aiming for blockchain will look into. You want your money to be stable, of course. The platform token is a different type of animal. Is used for service development. So you've got all of those projects looking into sustainability goals, climate change, or other non-payment scenario. They would use coins to really offer that transparency, that decentralization goals without the concept at all of crypto payment. You've got a concept of security token. Some of us may be talking about that as well. So this whole debate, right, about when I own this token, is it a security? And depending on what country you are, there are many views on that. So Seychelles might have a different view than other countries about if a particular token constitute a security. But in essence, it's an investment instrument. CBDC, I mentioned that. Again, this doesn't have to be a DLT based, but if it is, then it becomes a sort of crypto asset. So, right, and I haven't even mentioned, some other people will tell you there are at least 8 other type of crypto asset. I just picked up the top level, if you will. Now, the risk associated to, there are also there are some unique characteristics about blockchain. There are also some unique risks, and I'm just mentioning a few to just give you a flavor. Customers, and you may want to your legal system may want to have an understanding of that. The customer may lose their crypto asset, example, if the exchange get hacked. I think Marcos talked about that in the previous session. If the crypto wallet get hacked, which is your mobile wallet. They forgot their credentials. It's called a cold wallet. So if you use an exchange such as Binance, Token, Kraken, that sort of exchange place where you can buy and sell your bitcoins, for example, you may be safe. I mean, Binance was hacked 2 days ago. 7,000, if you will, tokens, bitcoins, as a matter of fact, were stolen, but they had some sort of insurance behind that. So people that were stolen their token, they will be reimbursed. But not all exchanges do that. So you may actually lose your token. But they use hot wallet. They use their own wallet. You don't even have your private keys from those exchanges. If you own your own wallet, there's a way actually to not even use those exchanges and still own, if you will, a Bitcoin. In fact, you can have a device that looks like this, a hardware, and put your Bitcoin on this. And this is the only place where it exists. It's called a cold wallet. And it could be, if you will, fingerprint recognition to unlock that device. It could be many ways. But this is the type of possibilities that exist with cryptos. Smart contracts. So this is an emerging, if you will, risks that we see. As more contracts are being put on blockchains, formal contracts are being coded as algorithm, put that on the blockchain to benefit from the unique characteristic of blockchains. Now, something I haven't mentioned, right, that you're already aware of. When something is a blockchain, it's on the blockchain for the rest of the history of mankind. There's no way to roll that back. That's also unique to blockchain. Could be a good thing for transparency purposes. It's actually a good thing. If there's a bug, that's a problem. There's no way to fix the bug. In fact, an emerging risk is about viruses on smart contract. There has been such attacks in the past. It's called the DAO attack, where a bug had been introduced on a smart contract and then replicated to everybody that was part of that decentralized network, and there was no way to fix it. The only way to fix it was actually something very, very difficult to do. It's called a fork. I'll talk about that in a minute. Anyway, that's an example of risk that is unique to be aware of. Or if the blockchain itself get attacked, Marcos was correct. Bitcoin blockchain has never been attacked. 51% of attack means if a majority of those nodes decide together to be bad actors, they can actually do whatever they want. They can steal your money. So on Bitcoin, there's enough of those nodes that are all around the world. There is no real way that they coordinate the effort to do that. But on other cryptos that have less nodes, like EOS, for example, is an example of crypto. I think they have 7 or 9 or a very limited number of nodes. You can see our majority could decide to change the rules. So there are some risk, and this is an example of something where policymakers, they need to be aware of that it exists so they can ask the right question without necessarily understanding how that works. Right, so another headache. Well, if you think that was difficult, check this out. ICOs. Anybody has heard by ICOs? I'm expecting most of the room to raise their hand. Initial coin offering, which is a way, if you will, to get funding for a particular project. So you invest in that particular project by buying some coin, if you will, with the hope that it would become more valuable, with the hope to participate to that particular project. So that was very popular last year. It started to fizzle out because there had been some questions whether those were actually securities, in which case you had to treat it in a very different manner, hence the trend to have STOs. Recognizing upfront that, yeah, sure, it is a security, therefore I'm going to comply upfront with some particular rule rather than being chased by the authorities. So security token offering have become very popular. But that's not it. There's a new trend for the past few months. It's called IEOs. Initial exchange offering, which is instead of different projects initiating their own coin and spending a lot of money through marketing and all sort of things to get your attention, they're going through the exchanges that you guys are already using today if you have Bitcoin, which is Binance, Kraken, and that sort of things, where the exchange itself, so Binance is the one doing it the most, says, okay, we're going to organize everything for you. We already have a network of customers that we can get the attention to. So we're going to do that. This is becoming extremely popular and expect that word IEO to be on the headlines of the news in the next year. Because the last project that went through an IEO to look for some funding, in 7 seconds, they reached so ICOs typically, they reach their goal in a few months, which was already amazing. IEOs, they managed to do that in a few seconds. So this is something to keep an eye on. Yeah, and if you think that was headache enough, that's not it, right? Token creations can be created many other ways, such as mining, which is the ability for those nodes I was talking about to create their own crypto, and therefore their own money in many ways. If it's a cryptocurrency, if it was an actual money, then it would be the ability to create their own money. Some of those crypto actually create airdrops, which from time to time, as a reward, they just drop current assets to owners, just creating assets out of thin air. Then you've got forking, which is if you like a particular blockchain, a particular crypto asset, you can actually take the code. It's usually open source, right? And you can either do a soft fork, which is you just create your own, like Litecoin became, if you will, a copy of Bitcoin, or hard fork, especially for fixing a bug, for example. Anyway, I want to go into the details of where to spend the whole hour on that. And in fact, that's kind of my conclusion here. So not all crypto, I wanted to give you a sense that it's not just crypto and deciding what to do with it. It's much more complex than that. So you need to be technology agnostic for sure to make sure that you don't have to change the regulation every time there is a new kid in the block. Again, IEO didn't exist pretty much a year ago. You don't want to change the regulation just because all of a sudden there is a new, what if the day after tomorrow you got an IT or whatever you call it. But it does require multidisciplinary collaboration to understand that. It is important that you do understand that those things exist though. We have found through the LearningCoin project that there is a lot of value in having internal projects within your organization, central banks or not, to really develop this knowledge about this technology. And it doesn't cost a lot of money. In fact, for the LearningCoin, we had 100 volunteers to give us their free time for free. So it didn't cost any money to build that particular technology. And we learned a lot. So I do encourage you to talk with me about a project such as this. I think that concludes my introduction.
Thank you very much. Thank you very much, Hergé, for such a comprehensive yet concise overview. I saw a lot of you taking pictures of the screens. Rest assured, the presentations will be circulated, so you will be able to. They will be on the website, so you will be able to find them there. Going from the theory and the overview to some practical applications, Bobby, you are the CEO of Merge Exchange here in the Seychelles, and you're in the process of exactly this tokenization we heard about in a previous presentation. Could you tell us a bit about that? Thank you very much.
Sure. I put together a very brief presentation. Some of these items on there were actually covered in the previous slide, so where they were, I'll move a bit quickly. But just wanted to give a kind of a brief overview of tokenized assets, and I'll give some examples and uses in terms of how we anticipate using these instruments with our exchange. Oh, sorry, I went one too many there.
Want to go back?
Yeah, I'm going the wrong direction, I think. Sorry, I'm going all through the presentation, guys. There we go. Maybe I figured it out. There we go. It has a bit of a delay. So what is a tokenized asset? So a very simplified definition is it's really any asset, and we're talking about investable assets here. The only reason you would want to tokenize an asset is if it's for investment purposes. So securities, money held in a bank, people are even looking at real estate, fine art, anything that people might want to invest in. which is issued and represented on a blockchain or distributed ledger technology platforms. We've heard a lot about those. I won't get into detail about the technicalities and mechanics behind those. But essentially, it's an asset rather than being recorded in, for instance, an Excel spreadsheet. It's recorded on a blockchain and distributed ledger technology platform. There's reasons why people want to have these assets on there, mainly around the tradability of them. Some examples we heard earlier, so fiat-backed stable coins, these are becoming more and more popular. So a US dollar-based stable coin, which is backed one-for-one with money held in some form of escrow, for instance. So let's say it's a regulated trust company, or there's even more and more banks that are actually issuing these coins themselves, where the bank's holding the cash. And another example, which is the primary focus of this short presentation, is security tokens. So the structure of a security token, there's sort of 4 layers if you go from the initial issuance all the way through to the tradability of the instruments. The first layer is the blockchain protocol itself. So this is the underlying protocol that defines the parameters and is in fact the programming language on top of which the security tokens are created. So some examples are the Ethereum platform, Hyperledger, Stellar, EOS, which we heard about here just a few minutes ago. Then the next layer is the security token smart contracts themselves. So this is essentially software that's powered by the blockchain protocol. It has to be written in conformity with the underlying protocol. This is where all the sort of functionality and embedded rules for these security tokens is created through these smart contracts. And sometimes there's actually a few different smart contracts that are all linked together to create this security token. Some of the examples, you'll see I'm a little bit biased for the Ethereum here. These are all Ethereum-based security token smart contracts. There's a kind of new security token standard that a lot of people have been working on called ERC 1400. There's ST20, which was developed by a company called Polymath, DS Protocol, which was developed by a company called Securitize, and then another one, R-Token, which was from a company called Harbor. So these were kind of early movers in the space that put a lot of time and engineering effort into coming up with these different security token protocols. So the next layer is the issuance platform. So you need a way to actually create these security tokens. You can kind of go in and do code in the background and interface with the blockchain in different ways, but most of us, wouldn't be able to do that. So we have companies that have graciously made that a little bit easier, and they've created these security token issuance platforms. So what these are is essentially a kind of simplified user interface that's using security token smart contracts that are sort of templates. And you go in and punch in some very basic information, push a button, and you've created your security token. So it's literally as easy as 10 minutes, and some of the platforms I've seen, you can create one for $50 yourself. So very simple. The issuer can do this themselves, and you cut out a lot of potential costs and intermediaries in the process there. One of the examples, I said merge. We actually are looking to create our own platform. It's not ready yet, but it is part of our plans in the near term for actually tokenizing securities. And then the next layer, and this is really one of the missing pieces in the market. A lot of people have been predicting that these security tokens, the whole world's going to be tokenized any day now. And one of the big missing links here really is the exchanges, because what people are realizing is it's great that you created this token, but it's not necessarily legal to go running around and trading these things back and forth and advertising that you have an offering and all of these types of things. So there are still securities and financial markets regulations, and this has been sort of a missing link. And the theory is that once more and more exchanges come about that are supporting these instruments, then we'll see a lot more securities actually being issued as security tokens. And that's in our plans, as was alluded to, which I can talk a little bit more about later. So just a quick example, the ERC 1400 security token standard. This has actually evolved into a suite of different protocols, and it's quite interesting. There's a lot of development work going on it. these things will continue to develop over time. I think that was alluded to as well. I mean, we're still in early days, but it's quite interesting seeing the community come together. This is all kind of open source and people pitching in from all over the place. But this particular standard has three main components. So there's kind of a core security token standard, which has, you know, a lot of the core rules. It has the rules around interfacing with off-chain data. There's any number of things that you can actually program into these tokens from a compliance standpoint, kind of preempting certain compliance requirements. You can put caps on the maximum number of investors if it's a private security, for instance, and you know, going above 1,000 makes you a public security. If you don't want that, you can actually program that in so that if anybody tries to transfer and it's going to result in more than 1,000 investors, it just won't allow it. So there's all sorts of kind of programmable functionality that you can put into these tokens. Importantly, it also has a controller function. And if you think about operation of law scenarios, this is a big problem with a kind of bearer crypto asset like a Bitcoin, for instance. If there was a, you know, a death in the family, so there's a probate issue, you know, so you have to pass the ownership of the assets on to a family member, or let's say there's a court order. You know, how would you enforce the court order? So you really have to have this controller functionality, and I don't see how it'll be lawful for securities to be issued without having this controller functionality, where somebody has to be able to go in and effectively enforce a court order. And the way that you would do that, you can't really erase the tokens, but what you can do is you can affect a movement from one account to another to enforce the court order. And I think that's going to be very important. And the last component of this protocol anyway is document management. So if there are important documents that need to be there to support the actual security itself, I mean, it could be anything from legal opinions to, you know, underlying title of a property or something like this. You can actually create a hash and link that document to the token itself so people can go and see that document, and it can't be changed from that point on. Some of the benefits, this is just a snapshot. You know, you look around and you'll see all sorts of different views from people in terms of benefits and challenges and risks. So some of the ones that I think are most applicable for security tokens are the cap table management. Now, just think about some very simple examples. I mean, theoretically, it should be easy to keep a register and keep a record of all your transactions. In practice, it's usually a mess. And the more shareholders you get, the more transactions you have. You see more and more errors in the registers themselves. And, you know, so you can have errors, but you can also have fraud. So one person has access to this Excel spreadsheet. You know, you better really trust that person. And if you have shareholders all over the world who maybe don't know each other so well, you could theoretically have more fraud issues there as well, which is much more difficult to carry out with a security token. And the nature of the platforms themselves are set up so that you can't have double spending. You know, so the immutability of the ledger, if you will, and the fact that it's replicated many times, it would theoretically keep a much more accurate cap table over time. Better compliance with laws and regs, the programmability of these security tokens like we were talking about before. There's any number of things that you can program in, and some of the more popular ones that are being programmed in is requiring that any investors have gone through KYC and AML processes before they're allowed to hold the security token. So the way that you do that and the way people are looking at that now is you effectively whitelist excuse me, the Ethereum address, for instance, which is effectively like an account, that would be put into a whitelist after the person's gone through and successfully passed KYC and AML policy requirements. So you can preempt anybody even being able to own the security, you know, unless they've passed the AML requirements. So there's a lot of these things that you can put in a preemptive basis, which saves time, saves money, reduces the need for intermediaries, and ultimately results in actually better compliance than you would have normally had. One of the potentially interesting things, I threw one in there, hybrid instruments. You know, we had utility tokens, these ICOs, and then now we have security tokens. I think that there might eventually be some interesting sort of hybrids that you can create out of those. So it'll be a security that maybe also, you know, gives you some discounts if you hold a certain amount on the company's products or services. Now, there's arguments that you could do that anyway, without combining those in a token, but there might be some interesting applications for that. Better governance. So, if you look at the way that securities are held now, a lot of times there's multiple intermediaries involved. So you have, CSD and custodians, and then on up the chain, and everybody's keeping different ledgers. And the kind of rights of the security holders, it's not always real clear, to be honest. With having the securities issued as security tokens and people being able to have direct accounts on the blockchain, in a lot of cases, they'll be able to hold it directly and be the registered holder, or at least they'll be much closer to that registered holder. Efficient peer-to-peer transferability. I'm not sure if Peter Munnings is back, but the last two sort of tie into each other a little bit here. If we kind of think of snail mail versus email, we were laughing yesterday talking about emails. You don't contact somebody in another country and say, hey, your email's coming. We just sort of expect that it'll show up now. It is easier to transfer these assets. You can transfer them between accounts on the blockchain. Might cost you 50 cents and take a few minutes for it to clear. And you kind of look at that compared to normal processes now to move securities between settlement systems in different countries. It's not necessarily an easy process, and you might not even be able to do it. If we wanted to have a cross-listing of a company here in Seychelles and someplace in South America, for instance, it might be very difficult to actually move that security from one market to another. And if you do, probably requires global custody links and lots of intermediaries and costs and time to do that, which ties into the last point here. And this is really from an exchange standpoint where we are most interested and most excited about these instruments. And it's their ability to create better interoperability between cross-border markets. And like I was saying a second ago, there's not necessarily great links, particularly in developing countries, smaller countries like Seychelles, where we're not exactly, as well linked as some of the markets in Europe and the US would be, for instance. So it creates new opportunities where issuers can access different pools of investors and be cross-listed on different markets and different jurisdictions, and theoretically make it a lot easier for people to move these assets back and forth. So think about a market maker that's participating in both markets. Theoretically, they could see a price mismatch, an arbitrage opportunity, and they could move their securities from one market to the other in a matter of minutes for not very much money, and actually trade between the markets much easier. The risks, there's lots of potential risks and challenges to everything, of course. Some of the ones that are most pertinent, I suppose, to security tokens are, getting down to the basic legal issues. So we still have company laws, and if a company's issuing a share or a debenture, a lot of times these laws were written a long time ago, and they're still very rigid with their processes. You still have requirements to maintain a statutory register of shares and debentures. So you need to make sure that however you're maintaining that, is in conformity with the company law. Transfer processes. So if the security isn't listed or dematerialized into a regulated settlement system, there might be some issues with the transfer processes because company laws a lot of times are still talking about written agreements and signing written agreements to transfer the shares or the debentures between parties. Cybersecurity, that's been talked about ad nauseum, I think, at the conference here. Hacking, fraud, there's always risks like this. I would say on this, in terms of security tokens specifically, having that controller function is a big mitigating factor for this. If someone does go hack a wallet and fraudulently move the securities, well, first of all, they would have to have put their KYC information up and be added to a whitelist so we'll know who they are. And secondly, the controller could actually go and reverse that transaction effectively. So it is a little bit more secure than a bearer crypto asset, for instance. And then, of course, just the blockchain network integrity. All blockchain networks aren't created equal. So it is important that the one that's chosen for the security tokens is very well supported, very well distributed, sound, and sustainable.
Thank you very much, Bobby, for such an in-depth explanation of a concrete example of tokenizing securities. I want to go on to another example. Arif, in South Africa, you experimented with using distributed ledger technology as a way of settling wholesale payments. Project Coca. I was wondering whether you could give us a bit of an insight into that. Thank you.
Morning, everyone. Caroline, I could see your expression through some of the slides. I thought that hot, cold, and forks were all related to meals. So I realize in just listening to you, Jens, which was an excellent delivery of the core concepts, that it's probably one of the most exciting times to be alive. But equally, it's probably one of the most scary times to be alive. So I'm just checking Emil. We still have time, and I can. Right. So I think yesterday, many thanks. Some of you had asked offline and online about Project Coca, and I ducked the question quite a bit and said, let's wait for the presentation, Frans. So I'm going to try and cover this as quickly as I can. It's not too many slides. But I'd like to, I think it's an important topic, so I'll try and cover it as succinctly as I can. Maybe I'll cover it under 4 pieces. The first is, why would we do a Project Coca? You know, a distributed ledger thing as a central bank. What would inspire us to do it? The second thing is, what exactly did we do? The third thing is, how did we go about doing that? And lastly, so what? Governor, you'd probably ask where to from here, right? So let me tackle it in that. But first, as usual, to put you on the spot. How many of you, as you heard in the opening remarks by Emil, think that this DLT stuff that has just been described, okay, I'm not talking about the crypto assets piece. How many of you think that the DLT piece for financial market infrastructures, meaning for payments, as you heard from the previous panel, securities or derivative markets, okay, is a load of nonsense, and it's a hammer looking for a nail? Okay, in other words, it's a solution looking for a problem. Just by signal of hand, please be brave enough. How many of you think the DLT thing, okay, is a solution looking for a problem? One person, and it's only Matt, and Doug is somewhere in between. I cannot believe this. Okay, Caroline, bravely enough. You know, I'm suspecting that if I keep talking, I'd find a few more hands go up. Okay, how many of you then, and I have to ask the question, okay, how many of you think it's the opposite? It's not distraction, it's actually disruptive. In other words, the token economy, blockchain economy, the networked economy through DLT, in 5 or 10 years' time is going to change everything that we know. All right. All right, so it looks like 3/4 of the room is undecided. So normally, when we ask this question, I normally get a room full of hands go up for the first question. And interestingly enough, a room full of hands that go up for the second question. And then that puzzles me a bit. And the reason why it puzzles me is I think it's often, and you've probably heard this, it's cliche, we probably overestimate the technology in the short run and underestimate its potential in the long run. Okay, and that's the tension between the two questions. So that's the kind of questions we were asking as a central bank. What is this DLT thing, and how could it change, in particular, financial market infrastructure? And that's why we did Project Coca, in truth. Okay? So, of course, we put a fintech unit. I described some of that in the session with Shamista. We put a fintech unit together with great challenges from the governors, asking us continuously to explain why we needed to do so. And when we put it together, a team of about 3 or 4 people, we were hugely excited back in August 2017. And of course, in that excitement, we put down 19 different projects that we could tackle as the small unit. Governors, of course, looked at that and thought we were talking absolute nonsense, and they needed to keep us focused. So here are the 3 initiatives. Where we are on that very briefly at present is that we've got a consultation paper that was released at the beginning of this year and a policy paper imminent in June of this year. The second one is they said, Ken, they said, well, you must think about innovation facilitators, hubs, sandboxes, guidance units, etc., and answer the fundamental question, why do you need these structures? So we're busy with that, and in about 6 months' time, I think we'll find answers to those questions. But the third one was, demonstrate to us that you can take some of this complex terminology thrown at us, smart contracts, zero-knowledge proofs, DLT, consensus protocols, and make something of it. Tell us what you think about it, but come back with a policy stance. Okay, we're busy renewing our RTGS system in South Africa, modernizing it, and one of the questions were, would you put the stuff rather on the traditional RTGS system, would you put it on a blockchain? And we had to answer that for governance. So that's why we did Project Coca. What is Project Coca about? Okay, Project Coca, and I hope I pronounce it correctly, is an isiZulu word. It simply means to pay. All right, and it started off, believe it or not, early 2018. We started in January, and we wanted to see, in particular, for wholesale payments in South Africa, very large value payments, over 5 million rand, between banks. Could we do this on a distributed ledger platform? Okay, we partnered. We didn't want to do it alone. So in other words, we didn't want to put 8 PCs next to each other and then say, there we go, we ran a proof of concept. Okay, what we wanted to do was partner with the network. We partnered with a number of banks. You heard from Absa Bank and so on yesterday, Capitec and a number of others. All right, but we also equally partnered with technology experts, Pete Munnings and so on, who in our view were world-class at understanding these particular technologies. Okay, and we partnered with PwC, who wrote up the report for us. Believe it or not, we started in January 2017. I can safely and humbly say many in the central bank who were participating in the project had no idea what a smart contract was. We had no idea how to spin a node, etc. But Pete Munnings and his team locked us up in a room for a week, and we thought it was insane, taking central bankers and locking them up in a room for a week. But in that week, I think you called it a JAD session or something like that, and we had to learn how to program, how to understand quorum, how to understand some of the protocols they were talking about. And we, during the first day, Pete said, don't worry, we've been through this with Mass, okay, and by the end of the week, we'll get onto the same page. And believe it or not, by the end of the week, people had then understood, and there was a common knowledge base as to how these protocols work, etc. Were we experts? No. Were we in the capable hands of experts? Yes. All right, and of course the project was managed, sorry, let me just go back, I hope this works. The project was managed by the Fintech unit. But here's the amazing thing. For those of you in the room, and I know there are many experts in the room, to put an RTGS together normally takes about 3 years, 5 years, okay? We did it in 6 weeks, okay? And I'll tell more of a story about that just now. All right, so what were we trying to do, okay? What we were trying to do, we were trying to get our feet wet, almost similar to the Learning Coin kind of story. We simply wanted to understand this particular technology, but in the context of wholesale payments, and we wanted to collaborate on it, and we wanted to contribute, okay, to the global body of knowledge, all right? But apart from that, we had a particular process that we went through. So I described very briefly the education process over a week, and it continued along the different weeks, okay, between 6 to 14 weeks. The second stage was actually creating the ecosystem. So again, I repeat, we didn't want each bank to simply come and put a laptop down and say, okay, there's my bank. We wanted them to build it in their own environment. So some of them built it on their local servers inside the bank, others did it on the cloud, others did it on different platforms. We wanted them to experience it for themselves. Okay? And the way that we spun up the nodes was Pete and his team helped each of the banks come on one at a time. But as the banks learned of the different problems that they were experiencing, they shared it with the other banks. Okay? And then, of course, the hard work began in developing the smart contracts, etc., and then, of course, testing. I want to reiterate that we did this, although it was a proof of concept, in the real world setting. We wanted the nodes, for example, to be at a distance. Some of the nodes were in Pretoria, others were in Johannesburg, some of them were in Cape Town. Next time we'll try and put some in the Seychelles, Governor. All right, so then what did we do? So apart from the broad goal of learning, we had some very particular goals. Here's 5 that we wanted to test. The first one was, can you actually do RTGS transactions, okay, using standardized formats, ISO 20022 formats that are familiar in the payments world? Big tick, yes, we were able to do it. Second one, can you process these messages at sufficient scale and in line with the current processing times? So we have a BCPDR requirement of processing between 70,000 transactions to about 100 at max within 2 hours, because these are mission critical transactions. And yes, we were able to do it. I'll share a bit more in the next slide. Could they propagate these blocks, sets of transactions, within 1 second? Okay, 95% within 1 second, and I think it was about 2 seconds for 99% of the transactions. The answer is a big yes. They were able to do that. Here's the big one. If you take out the central bank and you're asking banks to process transactions, these mission-critical transactions between each other, could you ensure the confidentiality and privacy of those transactions? Okay, and the answer is yes. How did they do that? You can talk to Pete Munnings in more detail over the break, but they managed to create new techniques, all right, leveraging things like zero-knowledge proofs, which I think you briefly touched on, but they used 2 particular techniques that were brand new. They used a Pedersen commitment, which allows for transactions to be shared privately and confidentially, and then they used something called, and I can pronounce it, an Istanbul Byzantine fault tolerance, a consensus-making technique that ensures that you do reach settlement finality. And I know that was a huge debate at the IMF when I made those comments, but we did achieve settlement finality. There are no hard forks when you use this particular technique, if I get it right. All right? So what did we see? We saw then that you could scale up in terms of transactions, and of course, we reached 70,000 transactions or 12 transactions per second in about an hour and a half. Now for RTGS, okay, that's great. For retail payments, okay, China Union Pay, you'll laugh at us. You'll say, hey, come on, 12 transactions per second is nothing compared to 25, 30, or 100,000 transactions per second, which is required in retail payment systems. Okay, but for RTGS transactions, this is pretty reasonable. All right, now I'll conclude. So what did we find? So if that's what we did, and that's why we did it, what did we find? Okay, this is a tough one. So we applied the analytic framework crafted by the BIS. It puts down 35 very difficult questions that you have to answer, okay, as central banks to conclude the suitability of DLT for a particular use case. Now, interestingly enough, I always argued with the BIS, you put central bankers in a room, of the 35 questions, guess how many relate to safety? Take a guess. Hey, 30. That's a lot. Okay, so almost 16 or 17 of those questions relate to safety. But that's because payment systems are very important. If they collapse or fail, okay, there's huge implications. So 17 of the questions relate to safety, another 7 around efficiency, and then the remainder around integration with current financial market infrastructure. And the conclusion was, as we went through those questions, okay, we would not put our RTGS on DLT at this stage. The technology is still immature, okay, and the benefit, if I think of the safety and efficiency benefit, it is not absolutely clear at this stage. Does that mean we would not consider using the DLT as a potential backup for the system? Possibly yes. I think one of you shared yesterday in an offline conversation that the Central Bank of Brazil have attempted to do that using DLT as a backup system. Okay, where to from here, Governor? I think we put down a number of use cases. The next one was we kept saying, look, if you've tokenized the rand and you've put it on an on a blockchain, is that good enough? No, because that's not all the transactions you do in the financial markets. You want to see bonds and debentures and securities on a blockchain. And how would that work? That's potentially the next set of use cases that we may tackle for COCA. Of course, one of the questions Shamista wanted to raise yesterday was, would you suggest that others do this, like in Project COCA, when other central banks have already tackled this, like Canada and the Monetary Authority of Singapore and the ECB and so on? And the answer at this stage is probably not. We're not convinced at this stage that putting bonds on the DLT would give us that much learning as has been seen by the other jurisdictions. However, here's some potential use cases that we think might be worth it. Cross-border transactions for payment versus payment, we think that's a hot area. There's just been a report released by the MAS and the Bank of Canada on that. Central bank issued digital currencies, okay, for retail payments. We're certainly exploring that. In fact, we've just put out an expression of interest last week for suppliers to respond to it in South Africa. And then, of course, the one that interests us a lot is we don't have a trade repository in South Africa or a CCP for derivative transactions, and we think that that's a hot area to explore. We think that given current regulations, which require a trade repository to be constructed, we think we can do this off a DLT. And that's probably where I'll stop. I think in final words, you know, I'll probably say, what was this project about? And I keep sharing with governors, this was not about the technology. Okay, this was about two capacities that we wanted to demonstrate as a central bank. The one is an absorptive capacity, the ability to learn fast, humbly. Okay, and the second one is an adaptive capacity, the ability to change fast. And those are not easy things for a central bank. Thank you.
Thank you very much, Arif, and a brilliant illustration of the point Hervé made earlier, that yes, it is important that the technicians, in this case, the central bankers, understand enough of the technology to be able to do something with it. And quite possibly courageous to say, not for now. Because usually when you have a pilot, you think, well, come on now the impetus is there, now we have to pull on, and to say, not for now, but maybe later. Finally, Nicholas Setoup, if we could have your perspective more from the regulatory point of view, how are you as a regulator, having discussed the risks that we have illustrated so far, that the previous three speakers have brought up, how are you as a regulator anticipating dealing with that? Thank you. Nicholas, you have the floor.
Okay. Thank you very much for the opportunity to share some thoughts on the matter. Kind of trying to represent two different entities today, so I hope I can humbly do so in a representative manner, rather. And I think, having heard the experts speak so far, and I would like to take one step back and take you a bit through a history lesson. We've heard about the complexities of Bitcoin, and it is really unsurmountable. You can really dig deeper, and you'll be studying every day, and you'll keep on finding new information. But if you go back, having worked as a central banker at heart, I think we keep on going back to currencies. I'm not equating cryptocurrencies to necessarily crypto assets at the moment. But if we look at the humble beginnings of money, how many of the audience have heard about the Yapstone of Rye? Okay, right. So when money started, right, in the ancient days, there was a community of islands somewhere, I think in the Pacific. And in order for you to actually pay for a plot of land or something like that, you would have this huge stone. It would be absolutely massive. It would weigh a few tons. And they would carve it out. They'd carve the stone, so it'd be a circle in the middle. So it's like a donut sort of thing. And they would roll that onto a barge, and they'd float it across to the main island, right? So imagine they're doing this out on Farquhar or something like that, and taking this to Mahe. So sometimes they would make it to Mahe, and they would land this piece of stone, and they'd put it in Victoria, because they couldn't roll it up the hill to get it over to this side of the island, let's say. And they'd keep it there. Now that stone would belong to somebody. That person knows that this stone belongs to them. And when they wanted to pay for a plot of land, for example, they would transfer the ownership of that stone to someone else. But since it's so heavy, you're not going to move that. So they keep it there. The crazy part is that at times, the barge never actually made it to shore. It sunk somewhere in the middle of the ocean. But still you know that that stone at the bottom of the ocean belongs to somebody. And they can use that stone to pay someone else with it. Right? Now that was one really interesting thing that I found about the history of how they used to exchange the value, exchange the ownership of certain assets without actually having to move this thing around. And then we ended up with cash eventually. But before we got to that, thinking of it, moving away from the currency side, but thinking of it in terms of asset, right, and accounting perspective. back in the 1100s, Charles I, there was a method which is commonly known as the tally stick. Now, have you heard about how the different grains of wood are each unique? Like each snowflake is unique in the world. There's never two snowflakes that are the same. Each wood grain is unique as well. So what they used to do is they'd take a piece of wood, or at some point it was bone, and they would cut notches in it. So you have a piece of wood, you cut some notches in it, which indicates something. Then you split this piece of wood into two. And I give you a piece, and I keep a piece. In that way, we're recognizing that, yes, we've transacted in this. So at one point, it was used for payments of taxes. So when you'd pay your taxes, you'd be able to put these two pieces together and match and confirm that, yes, they do match, or no, they don't match. Now, it's very difficult to forge it because the grains of the wood would be difficult to actually match. So thinking of these two little ideas in mind, this is what led to ultimately the creation of Bitcoin. People were not happy with the ownership of the financial sector by the big banks. They wanted to take that back and give it to the people. Right? It created other issues, which the creator of Bitcoin, somebody known as Satoshi Nakamoto, who nobody really knows who he is to this day, he would maybe not have wanted. He wanted a cryptocurrency. He wanted a digital, virtual type of currency that we could use to transact. Now, the value of Bitcoin has fluctuated so much that I don't think any of us would want to use Bitcoin to actually transact. One day could be worth, a few weeks ago, $3,000, and then it shoots up. Now it's a 6,350 plus this morning, so it's just too much of a swing. So I think we would all agree that this creates a big problem. But what Bitcoin did is it used something which we call cryptographic hashing. Now, what cryptographic hashing is, if we take the word blockchain, what does that tell us? Two things. Blocks, and they are chained together. Think of it like a prisoner chained to a wall, sort of thing. So it ties things to one another. So in essence, what blockchain does, or people are shying away from that term blockchain now and they refer to distributed ledger technology, is that each and every block has a sort of signature. Now the signature is created after the block is created, and it's put at the end. That signature at the end of this block has to match with the signature at the top of the next block. In that way, it creates the bond. It's like the glue that puts these two blocks together. So when you think of this, so you have one signature that matches to the next one, and then the one is created at the end, and it matches to the next one. So if somebody tries to tamper with one of these blocks, you will be able to see where the link is broken, and you can identify this. Now, this is a critical element, and it's one of the key benefits which distributed ledger technology brings for us. It allows us to verify the credibility and ensure that we know that whatever are in these blocks have not been tampered. Now, we could go a bit into the details and talk about the depth of cryptographic hashing and how it works. But suffice to say that, for example, if you pass a picture, let's not take a picture, let's take a sentence actually. Let's take a sentence such as, the dog is red. Right? If I pass that through a hashing function and I get an output, let's say, which is 64 digits long, it'll be random numbers and characters, right? Numbers and letters. Now, if I put a full stop at the end of the dog is red and I pass that again, the output from the hash function will be completely different. It is unpredictable. It's a one-way hash function. It's easy to have the input, run it through the function, and get the output. But from the output, it's virtually impossible to get from that output back to the input. But each time I give it that same input, I will get the exact same output, so long as everything matches. If I change one little thing, I capitalize one letter, the output is vastly different. There's no way you'll be able to tell what's the difference. So, what we do is, if we use this and we move beyond not only currencies, we start moving to crypto assets, we start recording our asset ownership onto a blockchain, we will be able to see who owns everything, and that cannot be tampered with. Like we said, we cannot go back and actually edit the blockchain. For example, if you've effected a transaction, the only way to reverse that transaction is to actually redo the transaction, but in the opposite direction, and that will be added as a new layer, not editing the current transaction. So we can credibly verify that everything that happens actually happened in a sequential order. And one key element that came up is the element of double spending, ensuring that once somebody takes this 100 rupees out of this pocket, they pay for something, they don't have that 100 rupees anymore. They cannot use that 100 rupees anymore. So this is also one key element behind blockchain. Behind distributed ledger technology and cryptocurrencies, we need to ensure that once somebody has spent something, they cannot spend it again. Right? So for asset registration as well, just imagine share ownership or land ownership. I mean, if I buy a plot of land today and I want to sell it tomorrow, I can transfer that ownership. I don't want to go back to the person I bought it from and just cut in the middle and transfer it to someone else. I want to say, no, it was me, and then I transferred to someone else. So when the payment is effected, it's effected to me. Right? In that same sort of mindset, we can enable smart contracts, which will also help. Now, smart contracts is just a fancy term. If I provide a service and I get payment, right? Think of trade finance. So when the goods are delivered, payment is effected. But without having to actually intervene, we can get the computer to actually recognize that, yes, the good has been transferred, and I'll automatically effect payment immediately. No human intervention required. Now, this could be really seamless. Now, from a central bank perspective as well, we also recognize that there are risks in this regard. And from discussions we have had with my colleagues, and for example, Alain from the Financial Services Authority, whom I'm representing, we do recognize that there are all these benefits that distributed ledger technology can bring. But we need to be mindful of some of the risks as well. So in the process, before I go to what is really being done on the ground, I would like to talk about some of these risks which we have thought about. From a central bank perspective, we know that AML CFT is a key risk that we are constantly focused upon. And the issue of correspondent banking relationship, de-risking, these are all very important. We have all heard how Bitcoin can be used on the dark web, on the Silk Road, to actually buy drugs and various other illicit activities. And this is not something we would want to be associated with. So we need to ensure that we have a very good mechanism to trace everything in place. Okay. One key element as well is the element of privacy. And when we talk about these sort of cryptographic functions, right, we need to think about your private key and your public key. Your private key is a bit like a password, but it's much more complex, right? It's a much more secure password. You need to make sure that this stays private and it stays safe. If you ever lose that, then somebody else can control your wallet, or they can actually effect transaction on your behalf, and they could purchase illicit items which you may not want to be affiliated with. So be very careful with that. So cybersecurity is a key element. Consumer protection is another key element which we want. We want to make sure that this system is highly available, it's up and running at all times, and that if you do lose money, you have to realize that the central bank cannot step in to help you with that. Now, there is the risk of a 51% attack, as has been highlighted, so I won't go over that as well. But if you own more than 51% of the nodes, then you can effectively write what they call the longest chain to block, right? So from discussions with Alain, we've also highlighted the importance of how assets can actually be stored on the blockchain and how it's untemperable, and you can credibly verify all these. Now, I realize that we are running a bit short on time, so I will try to cut it short there. But again, I am more than happy and always excited to talk about the subject matter. So if anyone has any questions, even afterwards, it will be an honor, and be very humble to try and share some of the thoughts. Thank you.
Thank you, Nicholas. I had quite a list of questions here, and by the look of on people's faces, I think there are also quite a number of questions in the room, but I get furious signals from the organizers that I really have to bring this to a close now. So thank you very much to my panelists. I'm sure you've given enough food for thought to whet everyone's appetite here to indeed engage vigorously with all of you during the break and lunch ahead. So please join me in giving a warm round of applause to our panelists. Thank you.
Before we proceed with our next panel, I would like to invite you for a short coffee break outside in the lobby. Please be advised that we'll resume in 15 minutes.
Madame sait pas quoi. Ni bien mort de sa banane, mais y a beau la pour le Christia.